For this computer. All right. So, would you like to introduce yourself?
Yeah, I'm Dave Mazza, the CEO of Roundhill Investments.
Okay. What brought you to Roundhill? What kind of background?
So I joined Roundhill in February 2023 after approximately 4 years at Direction as the head of product. And that firm was focused on really creating trading tools, primarily leverage and inverse ETFs for the trading community. Previous to that, I worked at Oppenheimer Funds, leading their ETF sales and marketing teams. And then the majority of my career before that was at State Street Global Advisors. I started in various portfolio management roles and then moved into their ETF business. And my last role there was the head of ETF strategy and research. So I've been involved in and out of ETFs for over 15 years and really have seen great adoption by institutional investors, financial advisors, and the retail public. And Roundhill, the kind of heritage that the firm had built off of primarily in thematic equities, now we've expanded into new areas, of course, was a great platform for what I see is this next wave of ETF adoption, where again, ETFs are used by all type of investors and for a variety of different outcomes.
Can you explain to the general audience what thematic means? Because both you and Sylvia have used this term now, and I don't think a lot of people know what that means.
Yeah, so thematic investing is an idea, a concept, and this is outside of ETFs, but because ETFs are really the preferred investment vehicle, you see that term used in conjunction. Is as opposed to thinking about traditional investments of maybe growth or value, just to keep it very simple, right? Where a growth manager would generally look for stocks with the highest growth opportunities, looking at forward earnings expectations, analyst revisions. A value manager would almost do the opposite, really not as concerned about projected growth, but more focused on the fundamentals of a company, price to book, price to earnings, price to sales, cash flow measures, what have you. Thematic investing kind of takes a different spin on that, and even a different spin than sector investing, saying traditional sectors like information technology, financials, industrials, don't capture actually what's occurring at the ground level. So thematic investing says, hey, there are themes in the market. Some of them are more kind of shorter term, some of them are longer term, right? So cloud computing is one. The metaverse is a theme. More recently, we have an ETF focused on generative AI. You're not going to find that in a traditional either growth portfolio or an information technology portfolio, because there may be names involved in generative AI that aren't just tech companies, that aren't just consumer companies. So it cuts across the two traditional measures of investing and combines names in a portfolio regardless of where they're coming from.
So we're not talking about Microsoft here. We're talking about something that's new, innovative, something that maybe the industry hasn't seen but has future growth upside. A name you would recognize. It's not Johnson & Johnson.
Yeah, and well, there could be a theme where a Johnson & Johnson stock or an IBM or a GE makes its way, right? Let's say there was a focus on industrial. If the industrial revolution was happening, there'd probably be some of those names in there. But generally, themes are either again happening now or expected to happen in the future, and you need to think about building and constructing a basket. You can do it with individual stocks, but that can actually be more time consuming and costly maybe than people would want. Mm-hmm. And so the way it can be done is through either an index or actively based ETF.
All right. What age range are you trying to capture? Are you looking for Gen Xers? Are you trying to capture the people that want dividend income, millennials? Who are you guys after?
When I think about sort of our broader, the full lineup of Roundhill ETFs, and we have 15 ETFs today, We just crossed over $1 billion in assets under management last week, which is exciting.
Congratulations.
We have tools and investments for nearly everyone, right? So if you're a long-term investor, and regardless of your age, but you believe that generative AI is going to be transformative, the chat ETF could be an opportunity for you. If you're a younger investor, or again, even an older investor who is focused on the need for current income, then products like QDTE and XDTE and YBTC, which are our covered call options-based strategies, could make a lot of sense for them. So I think oftentimes younger ETF providers, we were founded in 2018, get thought of as, oh, they're only focused on Gen Z or millennials, what have you. I think that's a bit of a disservice to just generally investors of all kinds. And so to me, it's more about what objectives that you have, right? Are you trying to build a long-term portfolio and save for retirement, or are you trying to have a particular kind of shorter term objective?
Okay, now, and I noticed you guys play, which I haven't seen a lot in other funds, is you play all sides of the field. You guys got the 2x leveraged, you got the inverse relation, you got covered calls. What am I missing? I mean, is there anything you don't do?
Not really. I mean, I'm sure there is. We don't have a fixed income product, for example. But that of course could change in the future.
So no annuities. All right.
Right. Or municipal bond ETFs or something of that nature. There's some great ones out there from other providers. I think about our lineup really kind of spans core offerings. We have the Roundhill Magnificent 7 ETF, and someone could say, hey, Dave, is that really core? And I'd say, if you're buying the S&P 500 or the NASDAQ, those are the 7 names in there. You can just own those with the Mags ETF, and you don't have that tail of others. So that's for kind of a longer term or medium term investor. Leverage and inverse for traders looking to take advantage and have the ability to monitor their portfolio on a short term basis. And then folks looking for income, we have that too. So as we continue to expand out our lineup, we really want to have products for all time horizons, and really what I think all investor types as well.
I like that. And you're right. The Magnificent 7 basically it is the index. You know what I mean? I don't know how much more are they at maximum, PE ratios though? Some of these are getting a little wild.
Yeah, so it's interesting. So if we take a step back, and we actually published at this point, it's about 6 months old, but heading into 2024, we had taken a look at the Magnificent 7 names and said, hey, we know that they're not necessarily cheap on traditional valuation metrics, but why might that be the case? And if you look at the data, today's market, it's really fascinating what's occurred. These companies actually have seen increased profit margins coming out of COVID. They've seen some of the strongest revenue and earnings growth coming out of the COVID period. And yeah, their multiples have increased, but others have too. And so there's become a bifurcation in the market where basically the winners, it's become a winner take all environment. So these largest companies, Alphabet's a good example. It actually trades at some of the least expensive multiples of those 7 names. NVIDIA, of course, and Tesla on the higher end. They're 7 names, but there's hundreds of companies, right? If you look at, again, Alphabet, just simply, it's a search. It has search. It has a cloud business. It has YouTube. It has investments in smaller businesses as well. The same can be said about Microsoft. The same can be said about Amazon. Yeah. So it's become these companies, because they're so large, they're demanding higher multiples than they had historically. Now, of course, that cannot always be the case forever. But in our opinion, until we see a material change in the economic environment, both positive or negatively, which would cause the Fed to materially cut interest rates, these names may continue to see their multiples remain relatively high. Of course, NVIDIA's reporting earnings next Wednesday, May 22nd. And there's going to be a lot of expectations on that, because a year ago is when they really put AI and generative AI on the map with their massive increase in chip sales. So again, this will not always be the case, but for the time being, there's a lot of still positives about Magnificent Seven when they're a combination of providing defense and offense in portfolios.
Now, the not necessarily COVID, but the last economic cycle we had companies like, GM and Ford, all these companies got major bailouts. Now if we do have another economic cycle, it's going to be, it's going to be Meta, it's going to be Google, it's going to be Amazon are the ones that are going to be too big to fail, right? Because they provide the infrastructure. Amazon alone with their pharmacies and all of their now they're a hospital basically. They provide too much value to the economy as a whole.
Yeah, it's kind of it is a fascinating phenomenon, and something that I think maybe why we're now seeing not to have a political conversation, but now why we're seeing the FTC get very involved and really almost blocking nearly every transaction that you see is because of that. I think there's broader concern about that, and you can, particularly with the growth of AI, play that out very negatively or very positively, depending upon your perspective. But that's one of the reasons why when we think about offerings, while we, from an investment standpoint, may still believe the mags as a group is attractive, we know that there's always a two-way market, and so we have MagX, for example, for someone looking to have magnified exposure and as a trading tool for the Magnificent Seven, or MagQ, which can provide an inverse on a daily basis exposure. So again, a ETF for long-term investing, and then 2 ETFs more for short-term hedging or trading. So again, depending upon folks' opinions, whether they agree with us or disagree with us, we want to offer them the tools for that.
In, I don't know, 10, 15 years, Gen Z or Gen Alpha is going to forget about, I don't know if you remember, like, parents ever going, well, we're not Rockefellers. It's going to be, well, we're not a Bezos. It's going to be, that's going to be
I'll
next
probably start saying that with my daughters. Yeah.
Where do we see the fund going? Any future plans? Anything we could look forward to? So
we're always at Roundhill thinking about new opportunities for investors, right? So we launched, for example, the first in the US covered call ETF on Bitcoin with YBTC, and that fund's been growing nicely since we launched that. We have a few more filings out there, an ETF that is coming soon, and we have this on our webpage under the coming soon section. There's only so much I can talk about because it's not live, but I can share the name and what its focus is. Sure. And so, we have the Roundhill GLP-1 and weight loss ETF. The ticker is OZEM. Hopefully launching soon, that we filed for. Okay. This is another thematic offering, an actively managed ETF that's really intended to be the first ETF focused just on stocks at the forefront of this weight loss revolution that we're seeing. So again, when we think about our lineup, always want to be looking for longer term opportunities for investors, and then we will be complementing that with ETFs that are focused on income generation and the like, as well, for a different group of investors.
While we're on that, is this fund, or I should say, are any of the individual ETFs, are they considered qualified dividends? I know that's like a big question right now in the market, is who's providing them and how do you get them?
Yeah, that really is something that depends on the specific ETF. Folks now, again, because there's, I think, have been an increase of interest in dividend ETFs. People are being more nuanced of where they are. We don't have that. I don't have that information to share in front of me because these are newer products. But that's something where people can kind of do a second level of homework, and you should be able to look at either. It would be, I think it's difficult for providers to project if they're going to be qualified or not. But as you get into kind of tax season or closer, to the end of ETF fiscal year, which tends to either be October 31st or December 31st, you can kind of start to get a sense of what that looks like.
Okay, so like, should we plan for, say, the Magnificent Seven? I believe it's a 2x, right? Isn't it a 2x multiple?
Yeah, so that the leveraged and inverse funds this is important to kind of think about. They're generally not, they're not really intended to be tax efficient, right? They're really intended to be trading tools, right? So they're not intended to be held over longer time periods. And so I wouldn't know right now if, what percentage of dividends in that fund would be qualified, for example. The, funds that are, again, it really depends on the percentage of holdings that are U.S. versus non-U.S. and whether they're fixed income or equity securities, for example. So, usually equity ETFs tend to have a higher percentage that are QDI, whereas fixed income less so. But that's going to vary, depending upon the provider and the time period.
Could the person watching this video right now, could they say, all right, we're gonna load up on these 2x ETFs until October 15th, capitalize on the market movement, and then go to, deleverage, go to the downside and move everything to the other ETF if there's going to be a huge sell-off?
Yeah, well, so important to note with leverage and inverse ETFs is that they're intended to provide that exposure on a daily basis. So it's only 2 times the return, again, today, tomorrow, Thursday. So they actually don't have longer term compounding. Now, some folks will come out and say, you cannot own a leverage and inverse ETF over more than a day. I disagree with that statement. What I would say, and this is very important, is investors, if they're going to own these products, whether they're from Roundhill or others, you need to have the ability to monitor your position daily and make a buy, sell, or hold decision daily. So because they have a much higher risk profile than a traditional ETF that does not reset or delever or relever daily. So I'm not in a position to recommend someone to make a trade of that nature. But if someone, for example, is looking to say, hey, I have, pretty significant exposure to the Magnificent Seven stocks or to NVIDIA, and I want to have a hedge when it comes to earnings day, but I don't want to sell my positions in case they go up. A daily inverse 1x fund like Magy could be very attractive as a trade, next week around NVIDIA earnings, for example. So again, folks really need to be able to make buy, sell, or hold decisions daily to see if that's something a position that they want to maintain.
So it's definitely not for the faint of heart, but if you were to set your buy and sell orders, you could make some significant traction.
For sure. Again, if you are a trader and you're focused on that, then yeah, these are tools that are intended for that. They can be very powerful for you if you have the ability to monitor them appropriately.
All right. Is Roundhill? Is it? Do you manage obviously you're the CEO, but who's watching the fund? Is it AI? Is it someone doing the daily trading?
So we have different types of ETFs in our lineup. And so whether they're actively or passively managed. So our chat ETF, which is the generative AI ETF, that is fully actively managed by the Roundhill Investment Committee, of which I am a member of. Then we have funds that are fully passively managed, for example, like our Metaverse ETF, ticker METV. That's fully passively managed. We are not making active decisions. We're following an index in that example. Then there's funds that I'd say are a little bit in between. They are technically actively managed, but they're rules based, right? So leverage and inverse ETFs, that's rules based on a daily basis. We are seeking to track the 2x and minus 1x exposure. Then you have funds like our covered call strategies. Those are not traditionally actively managed where we're saying, hey, today we're going to sell a call or not. That's not the point of the fund. So while they're actively managed because we need flexibility in the moneyness that may be bought or sold on a daily basis, they are really rules based of what the strategy is. So that's why in our FAQs, for example, on our web pages, we spell out if the fund is active or passively managed. We, of course, as the advisor to our ETFs, have oversight over all of them, but there is nuances in whether there's security selection happening or not.
And these are 0-day expiration, right, on the covered calls?
Yeah, so we have 3 covered call ETFs today. YBTC is the Bitcoin covered call. That is not, there's not daily options on that. So that is a monthly, the covered call strategy is implemented monthly. However, in the case of XDTE and QDTE, those strategies are daily traded products with that trade 0 DTE options on a daily basis. So the structure is really identical across the two. One is using a NASDAQ 100 as the underlier, the other the S&P 500. And the intention of these strategies is to provide overnight exposure to their respective market. So you have some beta to the market, but generate income each morning by selling out of the money calls on the index. And these premiums that are generated are paid out weekly. And that's a real distinction. These 2 ETFs are the only ETFs that pay investors weekly income in the market. And the benefit there is if someone wants to reinvest in the fund, they can. If someone wants to use the income that they've earned for expenses or other purposes, they can do that too. But the flexibility is there for them.
Is there any way to, and this is common, I'm not pointing out Roundhill, is there any way to offset the NAV erosion from those weekly payments?
Yeah, so ETFs that pay high distributions, and we're actually publishing a blog on this, which should be helpful, are subject to the potential for NAV erosion. And that can really manifest itself in downtrending markets. And this is an area that we encourage investors to get educated on. So in an upwardly trending market, even if I'm paying out high income, my price return of the strategy is going up. So the net asset value is not being depleted by the high distributions. With XDTE and QDTE, this is at Roundhill, the distinction maybe that we may have versus other funds. Generating income is the primary investment objective, but we're also balancing the sort of potential for NAV erosion. And so that's why you're going to see some variability on a week-to-week basis of what the actual yield would be, because there's variability in the market. And so we're not intending to kind of overpay, right? Pay you a huge distribution if the actual strategy is going to be way down. There's going to be some of that by nature of paying high. There's no way around it by paying high dividends. But we are trying to balance the fact that income has to come from somewhere. And if you're paying out too high of a distribution than you've actually earned, you're going to see erosion of the NAV relatively quickly.
Huh, okay. I have 2 questions from X. This one's comes from his username is My Investments. Compared to competitors, the expense ratio seems to be a little high. Is there any reason, or is there an added benefit to this?
Did they say what specific funds they may be talking about?
No, just the expense. You just said the expense ratio was high.
I think if you were comparing our ETFs to, low cost ETFs from some of the major providers, or larger providers, I should say, yeah, they're going to be costlier, because we're not intending just to provide broad-based beta to the S&P 500 or the MSCI EFA or what have you. So really all of our strategies are, I'd say, kind of objective based. Maybe the objective is thematic, maybe the objective is income, maybe the objective is leverage. And to be quite honest, trading and implementing those strategies is costlier, right? I was a portfolio manager at State Street before I joined the ETF business, managing what's called enhanced index portfolios. And when you move into markets that are either smaller cap, that are non-US, that are emerging, it's just costlier to transact in, costlier to custody. And so if you're trading options on a daily basis compared to just buying the S&P 500 stocks and rebalancing them quarterly, it's going to be costlier. So you're going to see slightly higher fees. But we think compared to comparable, I know that's a funny way of saying it, but our ETFs compared to their just direct peers, I think we're either in line with cost and in some cases actually less expensive.
Yeah, I think I pay 1% is pretty on average from what I've seen across the board. And that seems, whether it's real estate or it's really anything, you're going to pay a fee regardless of what it is to manage. And that's what it is. It's just a management fee.
Correct. Yeah, and some of it is, look, I've been involved in all sorts of ETFs of different shapes and sizes at different ETF providers, and we at Roundhill, at least, we do have benefits of the economy of scale. Now that does not always happen when you're smaller. We're growing and beginning to accrue those benefits, and so hopefully over time you'll see fees come down. But you hit the nail on the head. Some of it is a convenience factor, right? Certainly someone could go out and buy, in the case of Magnificent Seven, for example, just buy those 7 stocks. There's only 7, right? But you have to rebalance them if you want to do that. You have to remember to trade it. You have to be willing to sell your winners and buy your losers. And so 29 basis points to do that quarterly and the convenience of one ticker, we think is relatively attractive.
Yeah, no, it definitely adds up. And I mean, I do a lot on the real estate side. And I know from my personal experience, it probably cost me 1.25, 1.5% between just the overall management of whatever, I don't know, say you have a $800,000 house, you're going to end up paying maybe 1.5% yearly just to manage that between the taxes, insurance, all the, garbage that goes into it. You're going to pay it regardless. And that's just part of the game.
Yeah. 100%.
The last question, same person wants to know if MAGQ will reverse split.
If MAGQ will reverse split, well, we don't have any plans for it, and I probably couldn't speak to say if there would be. I don't see also generally conceptually a reason of why you would do that at I think let's call it $20, $25. You tend to see that at much lower levels. Mm-hmm. If any ETF, whether it's from Roundhill or not, gets to below $5, $10, $5, $2, which can happen, then yeah, you would want to do that. But at this level, I don't see that happening.
I think because of the Tesla had the reverse split recently, everyone's going they're just eroding into oblivion. So everyone's afraid of the reverse split now.
Yeah, I mean it's sort of interesting. So the one thing to bear in mind is that you on one hand you shouldn't necessarily care, again necessarily, if it's $5 or $25, right? Because you should think about kind of the aggregate investment. But it does have an impact of sort of the trading costs and things of that nature. So like I said, we don't see any reason to have any of our ETFs have a reverse split right now. But market dynamics and things of that change. Leverage and inverse ETFs, for example, if you look at where I previously worked, Direction, they were doing splits because the share price got too high, or reverse splits because it got too low, relatively frequently because they move around a lot more. But I don't think any ETF provider is like hoping that they have to do that, or really you shouldn't be launching an ETF at a share price too low if you're going to have that much erosion that quickly.
And what would you say is what is the best dividend paying stock you guys offer right now?
Right now, I think if we were to look at just purely sort of from a yield perspective, I'd point to 2. So QDTE, which is the NASDAQ 100 zero DTE covered call strategy, and then YBTC, which is the Bitcoin covered call strategy. YBTC's distribution yield is north of 50 right now. The month before, it was closer to 90 because of the volatility of Bitcoin. Wow. It's come down a bit, so it has a very, very high yielding potential. What I love about that strategy is I love the zero DTE option strategies as well. Don't get me wrong, but Bitcoin is inherently a volatile asset class. It's more, you would, I think, need a sea change in the market environment for, bear with me for a minute, for Bitcoin to be less volatile than stocks and less volatile than corporate bonds and treasuries. And why not take advantage of that, right? So if someone wants to own Bitcoin ETFs or crypto directly for upside potential, go for it. But if someone's also saying, hey, this is a really volatile asset, if I sell calls on it, I'm going to have the potential for high income and maybe with less NAV erosion, because even though I'm subject to a cap, I'm going to participate. A fund like YBTC may be very attractive to them.
Interesting. Okay. And there's no, do you capture all, does YBTC capture all of the downside if, say, Bitcoin falls, right, in 6 months, a year, whatever it is, and they fall down to 30 grand, is it going to capture 100% of the downside?
You would have some of the downside, absent whatever the premium that was sold. Yes. So your upside is to a cap, but you would certainly have some downside exposure as well. So it's not, there's no perfect trade here. Again, I do think it's a tool for investors to use in their crypto exposure.
Could we see one with like Ethereum? Do you guys have any plans for Ethereum?
Not we're obviously, we have our lab coats on all the time, and that's one that we're thinking about. I think there remains to be some question marks about approval for Ethereum spot ETFs, which we don't have skin in that game, but we're watching that closely to see what that may lead for Ethereum and see what we may want to do there.
My only a lot of people don't understand this, but Ethereum actually has an unlimited market supply, which people don't seem to understand.
Yeah,
that little whoop de whoop symbol thing that next to it. So it's very interesting.
Well, and you have staking. I mean, maybe not in an ETF, but if you can generate income different ways there. You can't do that with Bitcoin, which is why I think covered call or other types of strategies to generate income from Bitcoin are very attractive.
Is there anyone stopping? Is there anything stopping someone from, say, writing covered calls on your ETFs, like doing it themselves? Obviously, it's an ETF that's a covered call strategy. What's stopping someone from getting 100 shares and saying, I'm going to write my own covered calls on these and kind of double down?
We see options activity in these ETFs that imply that people are doing that.
Yeah.
Again, I have to say, if someone is doing that, just be aware of the risks that the pricing of YBTC is going to be impacted by the price of Bitcoin, by the covered call strategy itself, the kind of variability of that because of the volatile nature of the underlying asset. But if you have the experience or interest in doing so, there's nothing stopping you.
You guys are hiring, right? Is that
love it?
Right? Because that would make, if you guys are paying out I don't know, 1% weekly, and someone's just going, all right, I know there's gonna be a little NAV erosion, and I'm just gonna capture just a little at a time.
Yeah, I think so again, I've been doing ETFs for a while now. And I think what's fascinating is, one, conversations like this to begin with, the education of the direct retail public, even if they're not experts, they want to be, is awesome. The ability to trade more sophisticated tools that were only available to institutions like a State Street, that where I started my career 20 years ago, that's all changed, right? So the landscape has opened up, and yeah, if someone wants to do that, I would do their homework. And there's resources available like the conversations today to help with that, and go for it. I probably would be personally, do so with in a measured way at the beginning, but it's all available, whether it's trading tools or investing tools today.
Do you have any platform you like better than others? Are you a Robinhood guy, a Schwab guy? We generally kind of stay agnostic to the platforms. When I look at where are Roundhill ETFs held, it's really kind of across the board. I think the at this point, the older firms, the Fidelity, the Schwabs of the world, certainly have healthy coverage. But what we see out of Robinhood, to a lesser extent, public,
some of the other real kind of trading platforms, like a Webull or others, it's really exciting, right? And so you see, if you were to compare our ETF lineup, because again, we're a bit younger and have, we think, some dynamic products, you tend to see the more startup platforms covered as well. And it probably really depends on what people want, right? If you're just trying to do a set it and forget it, there's probably great product platforms for that. If you're trying to do more trading, you're going to need more resources.
Do you guys have any, and I've, who did I just talk to? Defiance was having this issue that, I just talked to Sylvia about this, is that some people are getting their dividends, say on Monday, and others are getting it on Wednesday or Thursday, and they're not able to capture that lower price NAV, or say they're reinvesting, they're not able to capture it because the way that, are you guys having that same issue?
Yeah, so the one thing I would say, and so we actually had a lot of questions coming in a couple weeks ago, because we did see this, is, and this, and I say this, and this may not always be the case, but Fidelity and Schwab seemingly do process the dividends quicker than Robinhood in this example. I don't know. Again, I can't speak to if that was a one-time anomaly, if that's always been the case. But yeah, we do see some variability of that, and we saw, there was a lot of dialogue, which I thought was, there's only so much we can do to help, right? Because the money left our funds, it goes to DTC and then goes to the brokerage and then ultimately into investor accounts. But as we were monitoring and trying to get information to help people from the platforms, the more technology and longer folks have been around, I think they're probably handling them quicker. But I wouldn't think that would always be the case as firms mature and get better.
Okay. In the next, I don't know what, 10 years, you're going to start seeing trillions of dollars coming down that are getting transferred from the boomers to Gen X, millennials, Gen Z, whatever it may be. How's Roundhill going to capture that?
Well, again, I think by having a diverse lineup of ETFs is how we're thinking about the opportunity to really work with a growing wave of investors, right? So we have tools for investors looking for kind of distinct medium and longer term opportunities. Generative AI, the metaverse, Magnificent Seven are great examples of that. We have tools for younger investors who want to focus more on income, or even older investors who want to focus on income. And we'll have everything in between. So we're not stopping, right? We just crossed over $1 billion. We were talking this morning about how we're going to continue to have great milestones, and that's going to come by working with investors. Our firm was founded on connecting with direct retail. We have a robust following on social media, and that's something we're going to continue to do.
I've noticed that there's been a big uptick in the energy sector, as far as like electricity. People want to get into ETs, obviously because of the tax status. Coal there's been a lot of talks around coal moving up recently with the Baltimore bridges collapsing, and now coal prices are going to have to go up. Obviously there's a big Australian market in coal, and China's burning a lot of coal. Can we expect anything from Roundhill in the energy sector?
We have one ETF focused on energy, which is LNGG. It's one of our smaller ETFs. It has not, energy has not been in favor until recently. This is a fund that tracks the performance of the Alerian Liquefied Natural Gas Index. LNG is share of the global gas is projected to increase from 13% today to about 23% in 2050. It's an interesting opportunity because it's a transition fuel as we go greener. So it's cleaner than other fossil fuels to kind of help with that. There's a lot of spending on LNG activity happening. And these are names that folks may not be as familiar with. Cheniere Energy, Santos in Australia, Woodside Energy in Australia. So for people interested in the energy space, we have LNGG.
And does that pay a dividend, or is it like just a growth?
Yeah, so that's a semi-annual dividend because those companies generally pay, because there's a lot of non-US names in there, and they actually pay semi-annually. And so the distribution yield on that is about 4.4%. So not eye-popping like others, but really, not intended to be. So these companies do reward shareholders with dividends. Some of them are kind of utility-like, but about 27 names in the portfolio today. So this is one where you could easily see a scenario, particularly with the election coming up, where LNG stocks either explode to the upside or maybe even the downside. So we think it's an interesting opportunity longer term. But for someone interested in energy, this could be an opportunity for them.
With the recent war going on in, I'm going to say, the Middle East, with Israel, have you noticed any sort of, at least I've usually this happens that like the oil sector and usually goes up, like prices of oil and gas usually go up.
Yeah, oil has been really benign. I think certainly it's been sort of in this really, I'll call it a fat and flat trading range for some time, where it kind of goes up to 100, comes back down to 80, and fluctuates between them. And so we haven't seen the explosion of volatility in the oil and gas markets, particularly oil, as you asked about, that we had seen before. I don't know. There's a couple hypotheses for that. One is generally investors are just becoming accustomed to these increase in wars and skirmishes, whether it's the situation in Ukraine, now tensions in the Middle East again. I would think if there is escalation from what's happening today, then yeah, we're going to see some upside surprises. But because it's been sad to say, obviously, because human life is impacted, it's been contained. And so we haven't seen that volatility. Volatility across markets, people were talking about the VIX getting to 20. That used to be this normal VIX level in the equity market. So it's been pretty measured across the board.
And you guys do you do precious metals or no?
We do not have any precious metals products.
Okay, so the boomers are out.
Yeah, it's funny. I mean, not to change the subject here, but there's been a real interesting phenomenon. I think some folks have picked up on this, but I'm surprised more of the mainstream kind of ETF media hasn't. Is, to my knowledge, we've never seen an asset quietly do so well. Gold, for example, it's actually year to date outperforming even the Magnificent Seven stocks, let alone the broader markets. And there's outflows. Usually you see coincident behavior, right? So, or momentum behavior, where ETF flows are going to where markets are going higher. That's not happening. People are actually selling gold ETFs while the price is just kind of quietly ripping. I don't know. That's not a space we cover, so I don't know why that's occurring, but I think it's kind of fascinating.
What I've seen on the streets, because I have a lot of friends who are either, they stack silver, they stack physical silver and gold. Silver, as of recent, has had like a 40% premium on it, whereas gold is like 5%. And so a lot of people are going, well, I can get more for my money just going buying, an ounce of gold. Well, obviously that it's kind of regulated on the ETF market because they're selling the contracts. I don't know if that has something to do with it, but you're right. Gold has been quietly going up, and no one seems to notice.
Yeah, it's and maybe people are buying. I know you can buy legitimate gold bars, not even coins, at Costco, right? So maybe that's why. It's got to be more. I would think some central banks and governments are involved because of the tonnage that's required for that. But if you're really scared about losing wealth, yeah, you probably don't want something in paper form. But I do think people probably shouldn't ignore what's either happening geopolitically or on the inflation side to think about gold and think about Bitcoin and all the kind of flavors that are available today. Maybe this is my personal bias, and I'm not here to give investment advice. But I think the two in combination actually are more interesting, maybe again, than people have given it credit for. And that's gold and Bitcoin. But I'm a older, I think I'm called a geriatric millennial. So maybe I have some boomer in me and some Gen Z and alpha in me. I don't know.
Yeah, I get it. I kind of feel the same way because I'm on that tail end of millennial where I'm pushing on Gen X's door kind of thing.
Yeah, same.
Being an 80s baby. Oh, I just lost it. I was going to ask you a question and now I lost it. What percentage of, I don't know, Roundhill Investments, say it's one of the covered call strategies, pays a nice dividend. What percentage of that would you, I'm not asking for investment advice, but say you were to hold it yourself. You have a little bit of Bitcoin, you get a little bit of gold, you got some real estate, and you want some income coming in. Where does that fall in line?
Yeah, I've been asked this before, and and I don't want to cop out when I say this because it's interesting. And this is less because I'm concerned about giving investment advice. It's more because it really depends on your objective. And so here's two kind of examples. One would be, I have a broadly diversified portfolio across a broad range of assets. And I'm 35 years old or 40 years old. And I have a longer, I'm fortunate to have a steady job, and but I have a family and a home to pay for. Your longer term retirement assets kind of need that growth, right? So you should be less concerned about income, but you need the having the income coming in can help pay those monthly bills and whatever costs you have. So, I don't know, 10, 20% maybe, but if you're just focused on, and we see people, I've had conversations with folks like this saying, I have other sources for kind of like wealth generation, or I want to use these dividends to help me create more wealth generation opportunities. I see people with much higher percentages as well. So it really varies. And to me, it goes back to my time horizon, right? So if I need current income today to offset the fact that I don't have as much current income from other sources, then these can be a higher portion. If I have income from other sources and this is kind of complementary to that, it can be you see it to be lower.
Okay, and is there a place? Say I was to use, I don't know, the NASDAQ 100 covered call. I'm collecting a nice dividend. I'm then to use those dividends to qualify for, say, a rental property and kind of double dip. Do you see any of that where people are using the funds to, say, fund another investment, or is everyone just reinvesting?
No, I don't think everyone's reinvesting. So again, we don't always, as a fund provider, while we can have conversations like this, we don't always are directly talking to end investors and clients, what have you. I think there's kind of three schools of how people are using these products, not just from Roundhill, from all of them. And of course, they're going to probably vary. There is folks who are just straight up doing reinvestment, using it to accumulate. And that probably would be the majority. Then, again, just for these general purposes, let's say there's a quarter and a quarter. Another quarter is doing some of this, using dividends from this source to fund another investment, and then another. That's complicated. If you can do it well, I think it's probably great, but it's definitely an added layer of complexity and need the ability to manage, particularly as nothing in life is guaranteed. And then there's a last group that's using them just to be kind of complementary and saying, and maybe less systematic, saying, hey, I'll take some income here and maybe I'll buy gold, GLD or another gold ETF with it, or what have you, right? It's kind of an opportunistic bucket, but the income's coming in and it can just be used in different ways. I can't speak to the tax efficiency versus any of those three, but it's generally those three camps.
Okay. How big is the team there?
We have 5 individuals. Hopefully we'll be growing, but we're a relatively lean and mean team, which is great. The management team is the 2 co-founders, Will Hershey and Tim Maloney, and then myself.
Okay. Yeah, I've talked to Mr. Hershey. It seems like a nice guy.
Yeah, we're all hopefully everyone has a chance to say this, but we're a great we have the Will and Tim took a risk, founded the firm in 2018. It's paid off. Now we're really I came on last year and was appointed CEO a month ago to really help us continue to grow and kind of get to the next level. They are still involved day to day, really focused on new product development. And so there's going to be, we have, of course, I mentioned OZEM, which is coming. And then we're also going to have hopefully a few other interesting ideas coming down the pipe as well. Those have not been filed for, but I encourage folks to kind of stay updated or follow us on social media or sign up for our newsletter and our alerts, operational alerts for more information on things like that.
And OZEM comes from that the new, was it Ozempic? Is that what it is? The weight loss drug?
Yeah, exactly. So it's a play off of that. So that is a class of drugs called GLP-1, and that's a medical term for really for what specific hormone or is being affected with that. But really, the idea is that if you look at the studies, the potential for helping with the obesity epidemic that we're seeing, not just in the US, but globally, is really strong because it can do more in a shorter period of time than you can get with traditional diet and exercise. And for some people, diet and exercise doesn't work. Again, I'm not here to give people fitness advice, but for people who need it, they've been very powerful. And these drugs were just, to me, the analogy with semiconductors is really apt. And the semiconductors specifically, I should say, for AI. So we're in the early days. People are beginning to talk about it, but we think there's a lot of more opportunities.
All right. Where can people find you if they want to interact with you?
So our website, straightforward, roundhillinvestments.com. There you'll see a section on all of our ETFs, our research page, an about us section, more information about our backgrounds. And then on social media, it's at Roundhill on X. That's really one of our primary, forums for that. We have relatively frequent posts. And then all of us individually, you can find our X and LinkedIn profiles on our website as well.
Can we expect like t-shirts or anything coming out? I know a lot of companies.
I don't want to speak out of turn, but we were actually just talking about merch this morning. And so hopefully we have some more things to share in that department soon.
Oh yeah. All right. We heard it here.
Yes. So you can say you heard it here first. Give us a little bit of time. But we will be working on some merch. Awesome.
Well, I appreciate it, Dave. Thank you for taking some time out. I know you got about 2 hours to market close. You got to capture those last couple of percentage points.
We'll do our best to do so. Thanks for having me on. It was a pleasure to connect.
Yeah, I appreciate it. And we'll follow up maybe like a year or something and see where you guys are at.
Sounds good. Talk soon.
All right. Thanks, Dave.
Bye.